Stop scrolling, because silver is entering a 2-week window where markets don't trend. They break, or they prove they can't. Here's the uncomfortable claim. If the financial system behaves the way it has behaved in every major cycle, silver is not about to drift higher. It's about to reprice. And when a reprice starts, you don't get polite candles, you get gaps, you get premiums, you get sold out signs. You get headlines that arrive after the move is already finished. Now, I need you to hear this clearly before the comments fill up with fear-mongering. This isn't a prediction video. This is a mechanics video, because if you understand the mechanism, you stop being surprised by the outcome. In the next few minutes, you're going to get 3 things. 1, the simple 4-stage pattern that repeats across history. 2, 3 historical proofs. Rome, Weimar, and the 1970s U.S., but told as a system, not trivia. 3 tells you can watch in real time over the next 14 days to see whether this turns into a controlled reset or a violent snap. Not predictions, signals. Now, let's anchor this with facts, not vibes. Fact 1, global debt is still sitting at an extreme level, around the $251 trillion range in 2024, just above 235% of world GDP in recent IMF updates. That is the planet living on future claims. Fact 2, the U.S. interest bill has become a headline by itself. Recent budget reporting puts net interest costs in the $1 trillion neighborhood. That means a rising share of cash flow is going to interest, money that has to be financed, rolled, or diluted over time. Fact 3, silver has been in repeated structural deficits. The World Silver Survey has described a major deficit in 2024, about 148, 9 million ounces after multiple deficit years. Translation, the world has been pulling silver out of inventories because mine supply hasn't been enough. Now connect those 3 facts. Debt is high, interest costs are high, and a critical physical metal is tight. That combination is why silver becomes a stress test, not just a commodity chart. Silver is small compared to global capital flows, which is why it can move violently. And silver is essential to industry, electronics, power systems, and the modern electrification push. So if confidence cracks, silver gets hit by 2 forces at once. The money bid and the industry bid. That's a double engine. Most assets only have one. So here's the mechanism. 4 stages, always the same skeleton. The names change, the math doesn't. Stage 1, credibility. The system builds trust in money, trade, and rules. People stop checking the foundation because it feels stable enough to ignore. Stage 2, claim expansion. Obligations grow faster than the real base can support. Wars, programs, bailouts, corporate leverage, political paralysis. The system chooses promises over pain. It funds the gap by multiplying claims. Stage 3, the control crisis. Confidence starts demanding proof. You see inflation bursts, shortages, bank stress, currency fear, yield shocks, temporary emergency measures. The story changes, but the plumbing is always the same. Too many claims, not enough reality. Stage 4, reset. Sometimes it's official, reform, default, controls. Sometimes it's unofficial. Hard assets explode in nominal terms while purchasing power quietly collapses. But the endpoint is identical. Paper gets dragged back toward the physical world. If you've ever wondered why everything looks normal, right up until it doesn't, this is why. Systems don't break linearly. They break when hidden stress crosses a threshold. Now we prove it. Rome first, not because ancient history is cute, but because Rome shows you the skeleton without modern distractions. Rome's early imperial coinage system worked. The silver denarius was trusted. Trade expanded, taxes functioned, soldiers got paid. That's credibility. Then the obligations grew. Armies cost money, borders cost money, politics cost money. Rome faced the eternal choice. Raise taxes enough to cover it, pay now, or borrow it from the future. It chose the future. And the tool was debasement. Reduce the silver content while keeping the face value. Claims expand, substance shrinks. Over time, people noticed, prices rose. Older high silver coins vanished into hoards. Newer, weaker coins circulated faster because nobody wanted to hold melting money. Trade distorted. The state leaned harder on controls and coercion. That's the control crisis. Confidence demanding proof while the proof thins. Then the reset. Reforms. New coinage attempts. Heavier taxation in kind. And a long decline in unified monetary trust. The lesson isn't Rome fell because coins. The lesson is structural. When you normalize shrinking reality to fund expanding promises, trust eventually breaks on the old terms. Second proof. Weimar Germany, where the pattern runs on fast forward. Before the spiral, Germany still had structure, contracts, industry, a currency people used. Then war costs and post-war obligations collide with instability. The state chooses printing because printing is the only move that looks like paying without admitting cuts. Claims multiply. Then the control crisis, disruptions compound, confidence collapses, and money loses value so quickly it changes human behavior. People spend immediately because holding cash becomes irrational. That behavior isn't madness. It's adaptation to a collapsing unit. Then the reset. Currency reform. The system is re-anchored to something that can credibly limit claims. Again, the story differs. The arithmetic doesn't. Third proof, the United States from Bretton Woods to the 1970s, and why silver goes wild when the anchor breaks. After World War II, Bretton Woods builds credibility. The dollar is linked to gold, and much of the world links to the dollar. Trade expands. The dollar becomes the central instrument. Then obligations grow, wars, programs, and the global need for dollars. The U.S. issues more claims than it can redeem in gold at the promised rate. Overextension. Then the control crisis. In 1971, the gold window closes. The old anchor is gone. The 1970s bring inflation and stagflation. Confidence in purchasing power erodes. Then the reset behavior. Hard assets reprice. Gold runs. Silver, smaller and more volatile, becomes a pressure release valve. In 1979 and 1980, silver spikes as inflation psychology and physical demand collide with positioning. Personalities get blamed. But the real driver is the mechanism. When the monetary anchor weakens, markets hunt for reality. Now freeze that pattern in your mind, because we're applying it to today, step by step, and we're going to say the quiet part out loud. Stage 1 today. Credibility was rebuilt after 2008, using emergency policy as normal policy, near zero rates, massive liquidity, backstops, whatever it takes. Markets learned a dangerous lesson. Money would always be available. Liquidity became the substitute for discipline. That belief became the foundation. Check. Stage 2. Today, claim expansion went global. Governments ran chronic deficits. Corporations levered up on cheap credit. Consumers normalized debt. And in commodities, layers of paper exposure multiplied. Futures, options, unallocated accounts, synthetic positioning, claims stacked on claims. At the same time, the real economy pivoted into a metal-hungry future. Electrification, grid build-outs, data centers, and solar manufacturing. That's not ideology, that's engineering. Verified. Now add the silver-specific pressure, repeated deficits. The world has been drawing down inventories to fill the gap between supply and demand. Undeniable. Stage 3 today, control crisis. And notice how it arrives as multiple fronts at once. Front 1. Inflation shocks reminded the public that purchasing power is not a guaranteed feature of life. Front 2. Higher rates exposed fragile balance sheets because debt only feels cheap until rates rise. Front 3. Higher government interest costs pressure policymakers toward the least painful option, stretch the currency over time, because austerity is politically radioactive. Now connect those fronts to silver. When a metal is physically tight, paper leverage stops being a clever tool and becomes a risk. Because at some point, someone wants conversion, delivery, allocation, redemption, the real thing. And the system has to prove it can translate paper into reality. That's where the next 14 days matter. In commodity markets, short windows matter because settlement mechanics matter. Delivery windows, inventory reporting, margin requirements, liquidity conditions. If the market can roll claims smoothly, price can whip around and the machine survives. If too many participants demand the physical layer at the same time, price doesn't trend. It gaps. It snaps. Verified. And here's the trap that kills most people's judgment. They think a reset must look like one dramatic event. It doesn't. It has two faces. Face 1, violent repricing. Silver moves faster than risk systems can handle. Shorts cover into thin liquidity. Spreads widen. Physical premiums jump. The price overshoots because the market is clearing a multi-year imbalance in weeks. People discover that spot price and get-me metal are not always the same thing. Phase 2, controlled reset. The system avoids a visible break by tightening the rules of stress. Margins rise, collateral tightens, settlement incentives shift, leverage gets throttled, and volatility itself becomes the deterrent that slows late demand. Price still reprices, just with guardrails. Either way, the principle is identical. Paper is forced to bow to the physical layer because the physical layer can't be printed. Now I want to give you a simple mental image that makes this unforgettable. Imagine a theater with 1,000 seats, but it sells 5,000 digital tickets because most nights, not everyone shows up at the same time. For a while, nobody complains. The ticket looks official. The email says confirmed. The staff smiles. That's credibility plus claim expansion. Then one night, the movie becomes the hottest show in the world. People arrive early. They line up. The staff starts stalling. Please wait, we're sorting it out. That's the control crisis. Then the unavoidable moment arrives. Someone counts the seats. There aren't enough. Now the theater has only two options. Admit the limit and refund, an explicit reset, or quietly change the experience, store credit, future access, hallway chairs, an implicit reset. Either way, the room didn't change. Reality didn't change. Only the speed of discovery changed. That's what a snap is. Silver is one of the few markets where that analogy can become painfully real because the metal is small, essential, and increasingly demanded by both industry and investors. Now we get to the part that changes what you do. What does a snap look like in real time? It comes in 4 beats. If you recognize the beats, you stop being surprised. Beat 1, attention shock. Silver starts moving hard. People who ignored it for years suddenly discover it exists. Search interest spikes. Comment sections fill with, "Is it too late?" The narrative flips from boring metal to unstoppable rocket. Attention isn't the cause. It's the sign the crowd has entered the room. Beat 2, positioning shock. Traders who were comfortably short because silver often mean reverts realize volatility is no longer a nuisance. It's an existential risk. They cover. That buying pushes price higher, forcing more covering, pushing higher again. That's not conspiracy. That's risk management under stress. Beat 3, physical premium shock. If demand concentrates into coins and bars, fabrication and distribution become bottlenecks. Dealers run out, delivery times extend, premiums rise, even if spot pauses. This is how you get one price on a screen and another price in real life. When that gap appears, the market is whispering. The paper layer is lagging the physical layer. Beat 4, credibility test. This is the boss level. When enough participants suspect the paper system is stretched, they attempt conversion, delivery, allocation, redemption. Not because they're villains, because they're rational. If too many attempt it at once, the system must deliver smoothly, delay, or settle differently. Whatever it chooses becomes the message to the world. Now here's the sentence that will upset both sides, but it's true. The next 14 days can include a pullback that looks like it's over, and that pullback can still be part of the snap, because snaps are not always straight lines. Complex systems often break, then oscillate violently as they search for a new equilibrium. Earthquakes have aftershocks. Currency crises have whipsaws. Commodity squeezes have shakeouts. The question is not up tomorrow. The question is new regime. So here are the 3 tells, the practical signals you can watch without guessing. Tell 1, spot price versus physical premiums and availability. If spot rises, but premiums stay normal and product is abundant, the move is mostly financial. If spot rises and premiums jump while availability tightens, the move is crossing from paper into physical stress. That's when small triggers create nonlinear outcomes. Tell 2, volatility plus rule changes. In every historical reset, institutions respond to stress by changing participation conditions, margins, collateral settlement incentives, position limits. When volatility rises and the rules tighten, that's not random. That's the system trying to prevent a disorderly unwind. Watch that behavior more than you watch pundits. Tell 3, the currency story versus the real economy story. When confidence is high, people believe in the unit. When confidence fades, they look for anchors. If policy language shifts towards supporting growth at all costs, or markets refuse to accept high rates without something breaking, you're watching stage 3 pressure. And when stage 3 pressure rises, hard assets tend to reprice, not because they're magical, but because they sit outside the promise stack. Now, quick recap in 10 seconds so you don't lose the thread. Credibility is built, claims expand, control gets tested. Reality forces a reset. That's the mechanism. So what would make this not snap? Be honest, if deficits vanished quickly, inventories rebuilt, and higher rates could persist without breaking the debt structure, the system could stay calm longer. But if industrial demand stays firm, supply stays tight, and the financial system keeps leaning on expanding claims to cover expanding obligations, the pattern doesn't stop because we want it to. It continues because it must, and that is why the next 2 weeks are sensitive. Because deadlines are truth serum. When everything is fine, deadlines are boring. When stress is rising, deadlines reveal what's real. Now, I need to say this clearly. This is education, not personal financial advice. Silver is volatile. Leverage wrecks people. If you're young, do not treat markets like a game, and don't risk money you can't afford to lose. If you ever choose to invest, involve a parent or guardian and consider professional guidance. With that said, here's the practical takeaway that doesn't require a prediction. Stop watching silver like it's a lottery ticket. Watch it like it's a warning light. If you understand the mechanism, you stop being shocked by the outcome. If you understand the pattern, you stop believing comforting stories. Because people always say, this time is different. They said it in Rome because the coin still looked like a coin. They said it in Weimar because printing felt like a solution. They said it in the 1970s because policymakers called inflation temporary. Today, denial wears modern costumes. American exceptionalism, as if arithmetic stops at the border. Modern optimism, as if technology deletes debt. AI will save us, as if software can conjure metal out of thin air. No, technology can improve efficiency. It can change demand. It can create new industries. But it cannot repeal the structural law under every reset. Paper claims cannot outrun physical reality forever. Silver sits exactly where that law becomes visible. It is the metal where the lie meets the ledger. So here's the final line. Listen to it like it matters, because it does. The next 14 days are not about whether silver is bullish. They're about whether the system can keep rolling promises without being forced to prove deliverability. If you want the next video, it won't be a price prediction. It will be the blueprint, how the paper machine was built, where the stress points are, and what happens in the next stage when the market stops believing the story. Subscribe, turn on notifications, and share this with one person who still thinks markets move because of news. Because the news is late, the system is early, and the clock is already ticking. Data references used for the key numbers, for your description, talk or pinned comment. IMF global debt. Monitor IMF blog updates on global debt. 251T, just above 130% of GDP. CBO budget reporting on net interest scale. And the World Silver Survey. 2025 on the 148. 9 MAS 2024 deficit. Plus early 2026 reporting on unusually large regional premiums physical tightness.